Welcome to NASDAQ Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the NASDAQ market site, we have Aaron Kaplan, founder and co-CEO of Prometheum, as well as Christian Pellegrino, director and head of digital assets of Alpha FMC. We're here to discuss the future of on-chain investment products and tokenization. It is great to have the both of you with us. Welcome to Trade Talks. Aaron, welcome back. And the regulators, they seem to have handed the crypto industry what they have been looking for.
Yeah, I'm not sure if it's just the crypto industry. I think what we're seeing is really the regulatory clarity introduced by the Genius Act, the Clarity Bill, and also what we're seeing from the SEC with Project Crypto. And what that's really allowing is
an important day is coming for every American with money in the markets, and it'll be here sooner than you think.
Assets are moving on chain, and we're seeing that in market infrastructure and in consumer financial products. And that's shifting how really the transition from databases to on-chain technology is going, which will really affect almost all financial instruments and their movements.
So remind us of Prometheum, you're getting the bird's eye view. Where within the ecosystem do you sit?
So Prometheum is, through its subsidiaries, there's a fully licensed market infrastructure that services the entire life cycle of a digital asset security. That's from the creation, meaning the minting and burning through a tokenization agent or transfer or digital transfer agent, the distribution through an introducing broker-dealer, the trading through an alternative trading system, and the post-trade side through a special purpose broker-dealer, which basically allows us to service the entire life cycle of a digital asset.
Yeah, and Christian, tell us about Alpha FMC, remind us.
Yeah, so Alpha FMC is a global management consultancy that's focused exclusively on the investment management industry. So we're partnering with the largest asset managers, wealth managers, asset owners, insurers across the value chain. So that's from upfront target operating model design and strategy through to evaluation and selection of service providers, technology providers, all the way through to implementations of technology and transformation initiatives. I lead our digital assets business, so that's working with traditional asset managers that are looking to get into crypto, but also the crypto native funds that are looking to scale their operating models.
It's interesting. You're starting to hear a lot of nomenclature that is familiar to institutional investors within the TradFi space.
Yeah, for sure. I think as Aaron was mentioning, there's been a reinvigoration in digital assets ever since the election, and especially through DC Week with the Genius Act being signed and the Clarity Act coming a lot sooner. I think it's being very clear that the U.S. is becoming the U.S. crypto capital of the world, and there's a lot of investment from global companies and individuals to ensure that they have a presence here and that we continue to build and innovate here.
Yeah, and Aaron, you wrote an op-ed recently for CoinDesk in the beginning of August. Is this a parallel or an upgrade when you think about it as it relates to the financial services ecosystem?
It's an upgrade. So when we look at it, historically, you have siloed databases when it comes to the different participants in sort of the securities or any sort of market structure. And it leads to redundancies. It leads to a lot of manual labor. And basically, by transitioning assets to being on chain, you eliminate significant amount of resource from a human's perspective at how it's done. You have arguably better record keeping. You have instantaneous settlement and movements of assets. And basically, it's just a better apple cart. So it upgrades the existing structure or database structure when it comes to the issuance and distribution and movement of financial instruments.
You made an interesting point in the op-ed as well that ironically, it's legacy crypto firms that are going to have to do some catching up here. What do you mean by that?
Well, I don't know if it's legacy that they have to catch up, but I think that, for a long time, they were saying that the lack of regulatory clarity really hindered the crypto industry. And, it did lead to certain letters being received and enforcement actions, whether justifiably or not, on the crypto side, but it really just stagnated the brokerage industry. And where were all the assets held? They're held on the brokerage side, right? You have all these accounts on the brokerage side that couldn't participate in the crypto space. But the crypto space continued to grow. That's where a lot of the younger generation participated. And at the same time, those accounts moved from the brokerage space to the crypto industry. But now with the regulatory clarity, with entities like Prometheum Capital authorized to do correspondent clearing for the brokerage industry, right? What that means is that the brokerage industry for the first time is on equal footing with the crypto industry and will be able to offer their customers the ability to trade and custody cryptocurrencies and other crypto-related brokerage activities.
Yeah, I think tokenization is going to be a catalyst for that as well. And we're starting to see asset classes really come online as it relates to that.
For sure. I mean, the success of the tokenized money market funds in the U.S. has been super strong. I think private credit's been another use case that's getting a lot of traction in the market today. You're able to get operational efficiency, saving basis points on trades, but also able to get more yield in the DeFi world. And I think what's really interesting, I don't know if a lot of people are talking about this, is of course, right, the Genius Act with stable coins bring a lot of traditional capital on chain. But what about all the on-chain capital today that didn't necessarily have traditional vehicles to invest in and put capital to work in? So I think it's this really interesting time where we're converging both worlds into one and making each other better in a way.
I also think investor demand as it relates to the democratization of alternative investments is a catalyst to look at as well.
100%. I think there is a very large segment of the ultra high net worth group that is underserved in today's current market. And I think there are traditional ways of fractionalization to get them more access. However, when you have the promise of transparency, accessibility, and liquidity, being able to have secondary venues to trade out of these positions and have even more liquidity in a very illiquid asset class, I think that's getting a ton of traction, both natively and non-natively in digital assets.
Aaron, is it fair to say that this isn't something that's going to happen overnight? I mean, from a market structure perspective, you just don't flip a switch, right? There's legacy assets and regulation that have to be integrated, and then, educating the environment as well.
Yeah, but for sure. But I think this is sort of comparable to the transition from paper to electronic markets. Right now, we just need to integrate sort of distributed architectures, the ability to custody these assets such that they're held in some sort of regulated environment, which is what Prometheum, through its subsidiaries, has really been working on for a long time now, right? And now that the universe has been opened up with this regulatory clarity, you're going to be able to see the banks, the clearing firms, basically entities that have sat on the sideline be able to offer these services, right? It might take a while to integrate the technology, but there's been a lot of entities that have been working on that technology to create these ecosystems that then could be leveraged by the big boys to enter the space quickly.
Yeah, well, I think it's a good point that you bring up about, electronic trading. I remember, I think it was April 2001 when we moved from paper to decimals. And I remember that being just a very key moment within the time frame of equity trading for sure. And it feels as if this is the next moment and there's really no going back.
Sure. And when we went electronic, you have to think there was all these different type of products that emerged. You saw ETFs, you saw different structured products, and going digital is arguably the next transition here, but it's on steroids because you'll be able to create bespoke products that are more innovative, that are suited to specifically to your customers' needs. Now, what does that mean? Well, good example is a money market token, right? A money market token can have an hourly distribution, right? And has instantaneous settlement. So think about the capital efficiency and the ability to get your yield at a much more reasonable and much more expedient manner, which will then allow you to go in and out of those instruments and earn yield on basically capital that's on the sideline waiting to be traded.
Yeah, Christian, I think it's a great point that Aaron brings up because we tend to think of investing in terms of what's the money I can make, what's the money I can lose, but the underlying infrastructure is really going to not only change how you're investing, but I think global capital markets and global commerce for that matter.
100%. I think there's also an opportunity here for, I think, traditional financial institutions to try to win back some of that, AUM or, that Aaron, you were mentioning that has gone to different brokerage platforms, not in traditional institutions. I think, this growing client demographic that's coming through almost expects these types of products, and the firms that are offering them and are able to innovate on those types of products are going to continue to win market share. And traditional asset management, it's just constant competition, right? So I think the ones that are really able to innovate and put their best foot forward to try to win back those that growing client demographic is really going to succeed.
I also think, I'm sorry, go ahead.
No, we saw that with Charles Schwab's announcement recently in terms of trying to be offering spot trading for Ethereum and Bitcoin. We've seen that with the actions of, you see the big boys like Citi and JPM trying to get into this space in a deeper manner. You're even seeing it on the payment side as well with companies like PayPal offering their own stable coins and basically everyone and their mother trying to offer a stable coin, right? So this will basically lead to this next step, this integration, and the big boys arguably have a second mover advantage here. Basically, they could choose the technologies they want. They understand sort of the pitfalls and where they best serviced here. And if you see the actual statements coming out from companies like Citi who are describing their stablecoin plans, right, they make a lot of sense, right? And it's a good use case, whereas historically, maybe like 3-5 years ago, you saw a lot of people trying to participate in the space, maybe doing pilots, but it was more like doing something just to do something, to say you're doing some sort of blockchain activity. Now the transition, the next step is actually using the technology to issue innovative products that increase your margins, that cost less, and that have benefits to your customers.
I think they're understanding the problem that they need to solve. Before, there wasn't that use case to help them to understand. You had brought up that everyone and their mother is introducing a stable coin. Are you concerned at all that it could cannibalize itself, or there'll be a proliferation of
Are you tired of trading systems that don't deliver and you just want to find something that actually
Assets out there?
So the transition to digital payments and to basically stablecoin-based payment systems is necessary in order for America to maintain its competitive edge. And when it came to the Genius Act, the Genius Act is the gold standard of sort of payment and stablecoin regulation around the world. And that's the first step there, right? Now, that will then allow us to be more competitive. There obviously has to be certain considerations because you can make an argument that this is almost the equivalent of the privatization of money or the decentralization of money, but it's all based on the US dollar, right? And the way that these stablecoins basically earn yield for either for the companies that are basically issuing them is by investing that actual money in treasuries, which basically is good for America.
Right.
It keeps down our borrowing costs. And the more treasuries that are invested in, the better it is for the US government, the better it is for the US dollar and US dollar dominance.
Right. And it also helps to mitigate that de-dollarization thematic that has been out there as well. But you had made a point before where you could bring newer investors back to traditional avenues. We can integrate. I think with passing this regulation as well, to Aaron's point, with the ability of stablecoins and infrastructure being built, we're also bringing in investors from all over the world that never had access directly to treasuries, U.S. equity markets, U.S. tokenized assets, and so forth. It's a circular economy here at the end of the day once we're getting more investments.
For sure. I think the really interesting part about being in the space is it continues to innovate. But then, if we think back just 3-4 years ago, how hard it was to operate in this environment where you could have been debanked overnight and, there's no access to capital. I think, with stable coins being now fully compliant, and, there's clear rules of engagement there. Firms are able to bank and have wallets and send global payments and realize efficiency there. But it also brings in that entire rest of the world that don't have access to bank accounts. And there's real concern over their currency, and they want to swap to US dollars as quickly as possible to maintain any purchasing power. So, I mean, I think it just unlocks so much more investment into the United States, into the investment products that we can bring. And I think ultimately great for everybody.
Yeah, I mean, you and I have spoken about this before, where we tend to think very U.S. and Western centric, and again about the trading, hedging, speculation aspect of it. But there are billions of people around the world where their infrastructure is essentially leapfrogged what we have here, and they are growing local economies because there's access to cross-border payments and investing and alternative forms of banking.
Yeah,
It's a massive
sure.
addressable market.
I think, what was it, maybe like almost a decade ago, you had M-Pesa in Kenya,
Yep.
which was a mobile payment-to-payment, a peer-to-peer payment system. And what you're seeing, I think this is really important, is as we're sort of mentioned here, is the extension of US soft power, right? Other people having access to US dollars is beneficial to those consumers because now they have a stable currency, and they have a currency, in theory, if they can generate yield on that, they would definitely keep their value in US dollars that are stable, that they can then plan for in the future, as opposed to a local currency, which might be hyper volatile and have some sort of hyperinflation type of, devaluation. So it allows those economies to benefit, but it also allows the United States to maintain a competitive edge when it comes to, a more sort of contentious world, whether it's what's going on in different parts of Africa or in East Asia. This will allow US dollar and dollar dominance to continue for the 21st century.
Yeah, and it's such a great point, because I think what we've seen is the rest of the world has really innovated a lot quicker than the United States, just given all the powers that be over the last few years. I do think we're playing a bit of catch up, but I think that offers a really unique opportunity here, specifically because these traditional institutions are forced to almost act very quickly. And there's two ways you can do that. One, you could spend a lot of money to build out that capability internally, or you can go acquire, right? So I think we've seen a lot of acquisition activity in this industry specifically, especially in like the vendor sector as well. So I think what clients want are front to back investment operating models, and they're going to look for partners that can offer them Apple service.
I also think the digital asset space has had their come to Jesus moment as well. You're nimble, but you also need the scalability of these larger institutions. And I think that's also helping to accelerate it, in addition to the operational framework that's around it.
Well, for sure. I think there's a bit of convergence there. Operating in crypto is very different. I think traditional institutions struggle with that a little bit, just given the API infrastructure and the open infrastructure that's there. I think those two are starting to come together pretty quickly. They're almost forced to, because that's the expectation for these types of clients. So we're seeing these traditional institutions hire that type of talent very quickly and start to open their minds in terms of how this ecosystem interacts.
I just find it fascinating, Aaron, as young as this asset class is, that we're watching the global capital markets evolve in real time.
Yeah, I mean, what you're seeing is the integration of distributed architectures and distributed ledger technology into market structure, whether that's on the security side, whether that's on the banking side, whether that's on the payment side. The reason is, as I mentioned in the beginning, it's just a better technology for the movement of financial instruments. And where historically we saw there was separation between, from a regulatory standpoint, from regulated financial entities and the crypto side, now with the president's initiative and Project Crypto and basically support from the government, right? You're seeing the melding of the two, because in order to maintain a competitive edge in market infrastructure, you need to have the best technology. You need to transition to instantaneous settlement. You basically have to offer these advantages, or else you're going to be disrupted. And the United States, in its proactive nature here, really deserves credit in the movement they've had since the new administration came in.
What are some hurdles that legacy institutions, or even newer crypto platforms, should be aware of? There's probably going to be some bumps in the road. Nothing is a completely smooth transition. What are some things that or you're aware of?
I think there's risk of having sort of over exuberance when it comes to certain elements of the technology. A good example of that is with certain elements of tokenization. Now, tokenization has been in the news recently because you're seeing major platforms, the Robinhoods, the Krakens, the Coinbase, basically tokenizing equities, but it's primarily outside the United States. And tokenization makes sense because it's basically the cryptographic representation of an off-chain asset, an instrument. So let's say an equity, you create a tokenized version of that, right? In theory, that makes sense because you could take advantage of being blockchain native, the instantaneous settlement, the record keeping, basically the ability to be used in DeFi and generate additional yield on your sort of collateral. But the risk there is also apparent when you have something like synthetic tokenization, right? Synthetic tokenization is basically when you create 5 tokens for every one underlying share, right? So basically, it's not fully backed. It's almost like a Luna Terra type situation
Right.
that came to stable coins. And we saw Commissioner Peirce come in and basically, I think sometime in July, and basically discuss that, tokenization is just another form of securitization and has to be done in a compliant manner under the securities laws if it's going to be in the United States. So you have the exuberance when it comes to the technology, but we can't get beyond ourselves and not consider the potential risks that would be introduced in the system if we sort of think of the technology as a panacea in and of itself.
Yeah, that's an excellent point. I mean, you can make the argument for any asset class.
You definitely can. I think there's another interesting point there where AML KYC is front and center for these of assets, particularly to the conversation we're having around democratization of alternatives. What happens with accreditation? How do we ensure that these end clients that are buying these in secondary markets are accredited investors? So I think there's been a lot of focus among this traditional community to, well, one, we need to understand what the clear rules of engagement will be, but then 2, how do we fit the legacy rules into this new ecosystem?
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.
Alrighty, everybody, what is going on? Welcome back to another CyberX video banger. In today's video, we're going to dive down the rabbit hole and cover some groundbreaking DeFi developments that involve Ripple, XRP, some other altcoins, but primarily fixating our attention on financial institutions that are evolving in this space to offer DeFi solutions to both retail and institutional investors. Today is going to be one of those video breakdowns that you're not going to want to miss. If you enjoy these deep dives, these thorough research video breakdowns showing you guys how ever evolving this space in the DeFi and crypto ecosystem truly is, then do us a favor, smash that thumbs up button and subscribe. Always keeping you guys in the loop with these updated and ongoing fundamentals to show you guys what you should be paying attention to. So we're going to dive in here today, and I'm going to start by reading this off to you all, because this is very powerful. It is a message that most people will ignore, but people should not be ignoring at this point in the game. So I said here, many retail traders remain skeptical about DeFi, often viewing it as unregulated or unsecure. That concern isn't unfounded. There are still areas of the DeFi ecosystem that operate without strong safeguards or oversight that I can agree with. However, those willing to look beyond the headlines will discover that regulated yield products do exist. In fact, they are already being used and offered by highly regulated and secure financial institutions, and many of these solutions are available to both retail and institutional participants. We are moving toward a full-scale utility-driven DeFi environment. This shift is not a matter of speculation, it's a visible trend. Holding on to an outdated perception of DeFi could mean missing the opportunity to adapt alongside the market trends. Historically, retail traders had the advantage of getting in before institutions. That window, however, is now narrowing as more institutional players previously on the sidelines begin integrating DeFi strategies, which I'm going to share with you guys in today's video breakdown. So the takeaway here is clear. Assess your risk tolerance, do thorough research, and recognize that institutional money is signaling where the future is headed. Those who learn how to implement DeFi yield generation strategies today will be better positioned to grow and protect their digital wealth in years to come. And then I tagged the little Wealth 28 logo because this is exactly what we've been touting to you guys for over a year now, almost 2 years now in the Wealth 28 Club. And now I'm going to show you guys those details and ongoing fundamentals. So first, I want to take you guys over here to this recent panel discussion that took place. And I want you guys to listen directly to an individual that comes from a financial institution that is heavily regulated titled Amina Bank. So this is a gentleman, his name is Miles Harrison. He's the chief product officer at Amina Bank. And listen here to what he has to say.
Yeah, from our perspective, yeah, I mean, Chris touched on being a regulated entity. We're a regulated bank, which is, kind of the highest level of regulation you can get in most countries. So we are under intense scrutiny, every move from our regulators, and rightly so. We're held to account on that basis. We are starting to see the institutionalization of DeFi. So CeFi is taking the best bits from DeFi and putting that into traditional financial systems. That might not be, if you're a DeFi purist, that might not be where your heart lies, but that is what's happening.
What does that mean? Do you mind expanding on that?
So banks, for example, for us, we're able to take tokenized collateral, right, which most banks cannot do today, right? They might have it in a sandbox. We have it live in production and can issue a loan tomorrow based on tokenized collateral. We take most cryptos, not just BTC and ETH. We take altcoins. Again, most lenders, regulated banks cannot do that today. We also utilize smart contracts to make the processes more efficient, to remove intermediaries, the very essence of blockchain as a technology in use case for financial services. And we also start to look at on-chain settlement. On-chain settlement becomes a bit more difficult because of the geographical spread and where our clients are based and whether something will stand up in a court of law. But we're starting to experiment with on-chain settlement.
So I wanted you guys to hear that directly from an individual representative from a regulated entity mentioned that they can offer crypto as collateral to their clients. And he mentioned Bitcoin and Ethereum and also other altcoins, right? So take into consideration people that still think that we're operating in an unregulated environment where DeFi is unregulated. Yet here you have an institutional participant letting you guys know that this is possible right now in the moment in a regulated environment. Now, this is a gentleman. He is the key founder of KeyRock. For those of you guys who do not know who KeyRock is, KeyRock in a nutshell is a market maker in the digital asset ecosystem. Take a second and listen to what he says, how we're entering into this era where things are going to start to ramp up soon. They're going to take the DeFi ecosystem and expand it substantially.
We had fully centralized players with all the control and no oversight whatsoever. And that's basically what led to, all the issues that we've had in the previous cycles. Now, this has somewhat matured, and it's not, we're not there yet, but we're on the right path where we're starting to have more and more actual oversight of the centralized players. But even more interestingly, we're actually starting to build something better with what is now available on DeFi, where you have this kind of baked-in transparency. Of course, it's not perfect yet, and we've had many debates over the day around what is still missing, in terms of regulatory compliance, for example, for DeFi to really be able to, become as big as I personally believe it should be. But I think still we are seeing this maturing on the market, and that has made a tremendous change. And I think we're still not at reach the high there was in terms of lending compared to previous cycle, but we are getting there. And more interestingly, we're seeing a really innovative solution now that, are going to dramatically increase the size of the market.
We're seeing innovative solutions unfold that are going to dramatically increase the size of the DeFi market. This is huge confirmation from a market maker that exists in this space right now. Now, his statement coexists with exactly what I said to you guys in this post, right? Many retail traders still remain skeptical about DeFi, often viewing it as unregulated or unsecure. However, that concern is not unfounded. There are still areas of in the DeFi ecosystem that operate without strong safeguards or oversight, but those willing to look beyond the headlines will discover that regulated yield products do exist. So just like that gentleman said, the market is maturing. We're not quite there yet, but we are on the precipice of experiencing huge developments that are going to drive this market significantly higher, which then coexists with what I said here, how retail traders had the advantage of getting in before the institutions, but that window is now narrowing. So this is why it's so important that you pay attention to posts like this, back with institutional insights from people whose opinions actually matter in this space. Now, just to take a look at this video, it was uploaded only on July 4th and has 128 views. Shout out to the CyberX researchers for sharing this panel discussion in our private Discord. I cannot stress enough that this is the type of information you want to be tapped into. So let's continue to move on. Ongoing with the Ripple developments in the DeFi ecosystem. This is directly from Marcus Infinger, the SVP of Ripple X. And he said here, in a recent conversation, by the way, this is only from 6 days ago as of time of recording. It is August 13th. Depending on when you're watching this video breakdown, it could be a couple of days later, but this is still within the last month. In a recent conversation with Leonard Schellberg at BN Crypto, they discussed how Ripple is unlocking the next phase of blockchain utility for institutions on the XRP ledger. I want to pause right there because this coexists with the post that I just recently made that for some odd reason, people think I'm crazy for saying things like this, but in reality, they're just not doing enough research. I said here, DeFi is about to be the catalyst that finally unlocks a higher XRP price. Not from cross-border payments, but from large organizations and whales putting their XRP to work. The moon prices that most crap influencers have been promising you for years is not coming from hype and cross-border remittances. It's going to come from a massive wave of DeFi activity. Dormant XRP waking up. Yet most people still don't have a profitable strategy or even know how to lend and borrow, how to stake and liquid stake, how to farm and vault, how to swap and connect the wallet to a DApp, how to tap into fractional ownership and yield generation with real-world assets. This is the new era of utility for XRP holders, and the ones who understand it early will be the ones holding the bag of profits beyond 2030, while the rest will be sitting in fiat or cash after they sell, waiting for some pullback that may never come. The Wealth 28 Club exists to make sure that you are one of those individuals that understands these things listed above. We give you the education, we battle test strategies, and the community to master DeFi and position yourself before the floodgates open. Stop guessing and start compounding. So back to this post from Marcus Infinger, the SVP of Ripple X. What is he going to say? The XRP ledger is acting as a foundational layer for financial applications such as tokenization of real-world assets. Two recent Ripple partnerships highlight this. Our work with CTRL at Alt in the Dubai Land Department has seen the DLD issue title deeds directly on the XRP ledger, which we've covered in previous video breakdowns. Guggenheim Treasury Services is issuing tokenized commercial paper on the XRP ledger in partnership with Ripple and Zeconomy. Now, I want to really highlight this partnership because of what Zeconomy is and what it offers. We'll get to that in just 1 second. As these use cases are established on the XRPL, new features such as the recently launched XRPL EVM sidechain, which unlocks DeFi capabilities on the XRPL, are further enabling programmable compliant DeFi, look at that right there, and paving the way for a multi-chain future. And this interaction between decentralized and regulated systems will become the normal. The importance of public blockchains like the XRPL, which offer transparency, immutability, and security, is growing. And so we're going to come over here to this recent announcement because this falls in line with exactly what I said here, that the next era and wave of utility on the XRPL is going to come from DeFi unlocks, right? And so if we go over to that announcement, here it is. This is from this year, June 10th, 2025. Let's thoroughly read through this because most likely the influencers on the internet telling you guys these high-end XRP prices missed this one completely. But this just goes to show that DeFi is that next unlock for higher XRP prices. Digital commercial paper DCP, a fixed income asset secured by US Treasuries and rated Prime 1 by Moody's, is now live on the XRP ledger, a public blockchain built for the efficient tokenization of real-world assets. Administered by Guggenheim and Treasury Services, one of the largest independent commercial paper platform managers in the world and wholly owned by a subsidiary of Guggenheim and Capital, DCP is a tokenized, issued, and managed through the Zeconomy platform. We'll get back to this economy platform in just 1 second. On the XRPL, DCP will leverage the network's fast settlement, low transaction costs, and round-the-clock accessibility. Then down here, it goes on to mention, DCP offers an ideal solution for digital traders seeking a yield-bearing, I repeat, a yield-bearing on-chain asset to use as collateral in their strategies. And you heard the gentleman from the financial institution, Amina Bank, mention that they offer collateral to their clients in multiple different crypto assets, including Bitcoin, Ethereum, and altcoins. Zeconomy's platform delivers institutional-grade models and a powerful toolkit that brings corporations and traditional finance participants together to solve real-world problems on-chain, said Jacinto Casano, the CEO at Zeconomy, in a statement. The expansion of DCP to the XRPL is a key marker for the future of tokenized finance, combining institutional strength with enterprise focus of Ripple, right? And so if we come over here to Zeconomy, for those of you all who don't know, look at this right on their page. It says, built for every financial ecosystem. And what do they offer right down here? From traditional institutions to cutting-edge DeFi protocols, our platform adapts to our unique requirements. They offer institutional finance, enterprise-grade solutions for banks, asset managers, and financial institutions seeking compliant DeFi integration, regulatory compliance, risk management, custodial integration, and audit trails all built in. They offer enterprise solutions, scalable blockchain infrastructure for enterprises looking to tokenize assets and streamline financial operations. They offer DeFi protocols, advanced financial engineering tools for DeFi protocols to enhance yield generation and risk-adjusted returns. They offer yield optimization, multi-chain routing, liquidity management, and protocol integration. This is huge. And guess what? The digital commercial paper, or DCP, which is a fixed income asset secured by the US Treasuries and is managed through the Zeconomy platform, just launched live on the XRP ledger, right? So I'm just trying to show you guys proof in the pudding. Now, this was also a huge announcement surrounding the maturation of the DeFi ecosystem onto the XRP ledger and what's coming for both retail and institutional investors. This is just yesterday. Vivo Power selects Crypto.com as a partner to support their digital asset treasury strategy. August 12, 2025, Crypto.com and Vivo Power International announced today that Vivo Power has selected Crypto.com to be a strategic partner to provide custodial support for the expansion of its digital asset treasury strategy holding. Announced today that Vivo Power has selected Crypto.com to be a strategic partner to provide custodial support for the expansion of its digital asset treasury holding strategy, as well as with regards to Corret's digital asset mining strategy. Now, what is the digital asset treasury holding strategy that Vivo Power launched? For those of you all who don't know, we covered this as well in a previous video breakdown. So if we go back to June 11th, 2025, you can see Vivo Power and Flare launched a definitive strategic partnership to deploy $100 million into XRP for institutional yield, right? And so if we come right down here, it says Vivo Power will generate yield via protocols on Flare such as Firelight and reinvest that income directly back into its core XRP holdings, creating a perpetually compounding and capital efficient treasury. Does this sound like they're buying XRP to then sell it for fiat currency at some high-end price? No, they're putting $100 million into XRP to generate institutional yield. I'm telling you guys right now, this is a wake-up call where you need to start to pay attention to what the institutions and the large organizations that are putting hundreds of $millions in the space are actually doing with their capital. So if we come back to this to continue reading, it says, Crypto.com Custody, Crypto.com's institutional-grade custody offering will provide the custodial services. Crypto.com Custody offers custodial services to eligible institutions and high net worth clients through a comprehensive end-to-end solution with safety and security at its core. With this partnership, Vivo Power shares will be available for trading through Crypto.com's broker-dealer, making it easier than ever for both crypto native and retail investors to trade. Through Crypto.com's platform, the shareholders will also benefit from superior liquidity for XRP and other digital assets, as well as access to upcoming XRP restaking via Flare, which Vivo Power has already partnered with. So again, huge announcements on the developments that are ongoing in the DeFi ecosystem on the XRPL, I cannot stress enough that if you guys do not know how to do this list of things efficiently and effectively right now in your portfolio, now is the time to learn. You can head over to cyberxtrading.com. You can tap into the Wealth 28 Club so that you don't have to risk your XRP or your cryptocurrencies to learn. You can watch us risk our crypto. Where in the Wealth 28 Club, you have over 200 private video breakdowns going over lending and borrowing, staking and liquid staking, farming and vaulting. And then heading into the future, we're also going to integrate strategies where we tap into fractional ownership and yield generation with RWAs. And you guys can do all of that and learn all of that without risking your crypto, which is what I personally recommend, right? Don't go out there and risk your crypto. Learn from other people who are willing to take the risk before you go out and take the risk yourself, so that way you know what you're doing. So that was just a huge ongoing development that I wanted to share with you guys. Back to this post that we started off with here today, because again, a lot of retail traders remain skeptical and they think that DeFi still operates in an unregulated environment. Well, down here on this post, I pinned this announcement from Bounce Club. So we're going to come over here and we're going to thoroughly read through this, so that way your skepticism can end and you can see that a platform built out by a regulated financial institution is available for the all, right? Both retail and institutional investors right now in the moment, where you can earn double-digit yields. I repeat, double-digit yields that are offered by a regulated entity. So again, go back in your thought process and on the influencer space on Twitter and on YouTube and watch how many people are still skeptical about double-digit yields. Meanwhile, a regulated entity is offering double-digit yield opportunities for both retail and institutions. So check this out. This post from Franklin Templeton Digital Assets reads, Franklin Templeton is pleased to share that the Benji token, representing shares of the Franklin on-chain U.S. government money market fund, is now being used as a base collateral in structured yield strategies developed by BounceBit. This marks one of the first implementations of a regulated fund operating within an on-chain financial infrastructure. BB Prime, BounceBit's platform, will serve as a bridge connecting institutional fixed income with automated crypto execution. The platform supports regulated custody, smart contract-based capital allocation, and automated execution of strategies. BounceBit's pioneering CDeFi, or centralized decentralized finance infrastructure, offering institutional-grade yield products, restaking use cases, real-world assets integration, making high-yield opportunities accessible for all. So I want to really thoroughly break down this platform and dive a little bit deeper. So this is an AMA recap that they had via a Twitter space that you guys can go and tap into. I highly suggest that you go and you listen thoroughly through this. It's about an hour long and you're going to find out so much good, valuable information. But it says here in the recap, BounceBit has plugged Franklin Templeton's tokenized US T-bill fund, Benji, into its BBB Prime, creating a dual yield structure, earning steady T-bill interest while running delta-neutral crypto arbitrage. This is a huge part right here. It says Franklin Templeton shared in this space how their on-chain fund pays intraday yield 24/7 with per second accruals, and how collateral mirroring with OKX and Standard Charter lets assets keep earning even while they're locked. BounceBit's approach is a first moving fast in all regions trading hours. In live tests, the strategy produced 22% APY by stacking regulated asset yield on top of crypto returns. I repeat, 22% APY by stacking regulated asset yield on top of crypto returns. You cannot make this up. So for anybody out there that is on the internet that is still telling you guys that double-digit yields should be seen as something that you should be skeptical about, this is a regulated product right here that's offering this type of yield. This is huge. So with APAC at the center of global trading flows, the path is clear. Starting with institutions, then opening up to retail, bringing the first truly integrated TradFi crypto yield model to the market. So let's dive into this platform. If we come over here, this is their platform, BounceBit, and this looks identical to some of the protocols that we run strategies on right now in the Wealth 28 Club, which is just so phenomenal, because coming from the unregulated DeFi ecosystem to then coming over here and participating in regulated products, the user interface is literally identical. So here is the user interface. It's really great. I'm not going to do a whole entire walkthrough on this user interface, but straight up here in the right-hand corner, you can connect your wallet. And they even have a wallet connect feature, which means that it's probably compatible with cold storage wallets like Tangem, right? So you can use this platform directly through your cold storage wallet, likely, and you can earn yield. Now, I want to come over here to the docs part of this because it says this is where you really want to thoroughly read through and understand this platform. Check this out. The BounceBit-C DeFi system operates as an optional feature suite integrating regulated custody with decentralized yield generation. The architecture leverages Sifu's custody infrastructure to enable delta-neutral holding strategies while maintaining asset security. The system's foundation rests on two primary custody providers, Sifu, formerly known as Binance Custody, and Mainnet Digital. These regulated entities implement a multi-party approval system for asset movements, ensuring comprehensive security through a robust regulatory compliance framework. The reason why I'm reading this to you guys is because, again, we are in an environment where misinformation is at its finest. And you have a suite of uneducated retail investors that are still telling you guys to be extremely cautious and not touch DeFi because it's unregulated. Yet here you guys have a regulated product. Again, I'm not saying to go out and use it, but a regulated product that you could go out and do research on and educate yourself on, which coming over here and reading the documents, by the way, on this platform is absolutely free. It's free to educate yourself on these platforms. So don't ignore your education. I highly suggest you guys come over here to the docs on this platform, read thoroughly through it, and educate yourself on what is possible, the rewards that you can generate, the yield that you can accumulate and compound, as you guys heard, every second of every day, 24/7. This is a huge step up in the DeFi ecosystem that most people are ignoring. So I'll leave it there. It is now up to you guys to come over here and check this platform out. Again, I'm not supporting this platform or telling you guys to go out there and deploy on this platform by any means. But what I am showing you guys is that these platforms are being offered by regulated entities and at scale right now for you to start generating yield and expand your wealth. As we continue, I have yet again another fundamental piece here for you guys showing regulated entities in the digital asset ecosystem are screaming staking, yield generation on layer one blockchains and altcoins that you most likely know about if you've been watching us here on the CyberX platform. This announcement is coming from the Soi Foundation. Pause real fast before we thoroughly read through this fundamental piece. If you guys are enjoying this research so far, showing you guys that now is not the time to be skeptical about DeFi, and instead, now's the time for you to engage in your education in this space. You do not have to go out there and risk your hard-earned digital assets to learn about these things. Read thoroughly through the fundamentals. Everything that I've done here for you guys today is absolutely free. And all it requires you to do is unlock your way of thinking and stop thinking with this outdated mindset from 2022. It's now 2025. The space has matured. DeFi is evolving, and now is the time to adapt and learn and start to integrate or consider integrating yield generation strategies in your portfolio to expand and grow your wealth. So if you guys are enjoying this, smash that thumbs up button and subscribe. It does help boost the algorithm. Share this video breakdown to a friend or family member to get their way of thinking expanded as well. Let's continue to dive back in. So here it says, Soi goes Swiss bank grade. Soi is now fully integrated into Sygnum's regulated banking platform, unlocking custody, trading, staking, and treasury services for institutional clients. And here is the direct announcement from Sygnum Bank, where it reads, Sygnum Bank announces Soi support for clients on the back serving as a banking partner to Soi Foundation, broadening access to the blockchain built for mass adoption. So just reading some highlights, I won't thoroughly read through the entire post. It says, Sygnum is the first Swiss bank to launch Soi, and that was back in July 2025 with custody and trading offering. By serving as a banking partner, Sygnum broadens regulated Soi ecosystem access and further expands the reach to professional and institutional investors. Staking and Lombard loans for Soi is coming soon. So they will offer staking and collateral features where you can most likely take out a loan very soon, it says here. Soi is held off balance sheet and secured with Sygnum's institutional grade multi-custody solution. Then it says, we are pleased to be a banking partner for the Soi Foundation and expand access to professional institutional investors via Sygnum, a regulated bank, said Matthias Imbach, Sygnum's co-founder and group CEO. Signum's unique understanding of digital assets sits at the intersection of the rapidly converging digital asset and regulated financial ecosystem. We are excited to support the Soy Foundation in developing the future-proof, opportunity-ready treasury that it needs to continue to grow its trajectory. Last but not least, before we wrap things up, to full circle back to what I said at the beginning of today's video, how the DeFi ecosystem is maturing and it should not be faded indefinitely in terms of your education and furthering your knowledge about the space. Check this out again for the first time ever in history. This was announced on August 8th, 2025. The S&P Global Rating has issued a B- stable outlook issuer credit rating to Sky Protocol, formerly known as the Maker Protocol, making the first time ever a decentralized finance protocol has received a formal credit rating from a major agency. Sky Protocol is a decentralized lending platform built on the Ethereum blockchain, where it enables users to mint USDS, a stablecoin pegged to the US dollar, by posting accepted collateral, where depositors can earn yield by placing USDS into savings vaults, receiving savings tokens, SUSDS, in return. With a market capitalization of 7.7 billion, USDS is now the third largest stablecoin globally. Jonathan Manley, global head of market outreach at S&P Global Rating, said that the rating represents a significant milestone in the evolution of decentralized finance, and it reflects the agency's commitment to improving transparency in the sector. The rating underscores growing institutional engagement with blockchain-based financial infrastructure as traditional frameworks begin to intersect with decentralized systems. This is, again, happening for the first time ever. And so think about all the people that are living mentally in the past, thinking that DeFi is still some scam, that it's not regulated, that double-digit yields should be shied away from, and that you should not pay attention to them. Well, here in this community, I cannot stress enough that now is the time to not ignore your education, and instead it's time to engage with the ever-evolving ecosystem and the ongoing developments in DeFi. With that being said, hopefully you guys enjoyed today's video breakdown. If you did, do me a favor, smash that thumbs up button and subscribe to the platform. We do appreciate the love and the support, and we will see you guys in the next video breakdown. On Wealth 28 Club members, this is going to be a very brief video breakdown going over my flywheel strategy in the Metallicus ecosystem, looping the stake rewards from the XPR staking over into a farming pool, then harvesting those farming rewards and putting them back into the stake position. So in a nutshell, to give you guys a visual display, this is kind of what it looks like, where we are earning 4% on our stake XPR. We're then taking those rewards and putting them into a farming pool, in this case on the MetalX platform, the MetalX app, where you have the ability to enter into these farming pools. Currently, as of time of recording, it's earning 56% APR. Then the rewards that we're getting from that pool, we are harvesting those rewards and putting them back into the original staked position. So this is a visual display of what that flywheel looks like. Now, in the future, once these positions and these rewards grow, I will be adding an additional layer to the flywheel, where you can see here the rewards that we're going to be harvesting from the MetalX farming pool. We are going to be putting into the lending platform on MetalX Lending into either USDC or XPR, earning anywhere between 5 to 19% as of time of recording this video breakdown, keeping in mind that those APYs do fluctuate. And then instead of putting the harvest rewards back into the staking position, we'll be lending out these harvest rewards in either XPR or swapped for USDC, lending them out, and then taking those rewards that we're earning from lending back into the stake position. I won't be participating in that until my positions grow a little bit more. So that way it's not just little tiny pennies. I will add this additional looping feature here in maybe some coming weeks or months to come. All right. But so for now, we're just going to focus on this. Some prerequisites to this particular video breakdown, if you're new to the Metallicus ecosystem, are having a WebAuth wallet and being KYC'd in the WebAuth wallet. All right. So if you're not KYC'd in the WebAuth wallet, you are going to need to pause this and go and do that right now and make sure that your WebAuth wallet is funded. All right. So you can just head over to webauth.com. However, we're going to be doing this on the mobile app. You also can do this in the mobile app directly through your mobile device. That is how I'm going to be doing that. Depending on, your preference, whether you like it on the computer or you like it in your mobile, that's up to you. I'm just showing you guys a prerequisite. So you will need a WebAuth wallet and you will need a KYC. Now, once you go in and sign up in the WebAuth wallet, then you'll be able to KYC. And so that way you can fast track through the KYC process. There's a little tiny button inside the WebAuth wallet that allows you to speak to customer support. Go in the customer support tab and say, hey, I'm trying to KYC. And they usually will fast track you, within the first day of you going and sending in your KYC credentials. All right. So that we don't have to wait 2 weeks or whatever the prerequisites are. So again, you're going to need a WebAuth wallet, at least for this example. All right. Now, also another app that we're going to be utilizing is the MetalX app. All right. So that is going to require that you understand how to navigate the metalx.com. And then coming over here, if you're on the, obviously, of course, browser on a laptop or a desktop, this is what the platform looks like. You will come up here and you will click Launch App. And you will need to connect your WebAuth wallet. Now, this is the same interface if you're doing this on mobile. So on mobile, same thing, metalx.com. There's a little button up there that says Launch App, and then you just connect your wallet. So same thing up here. You'll need to connect your wallet up in the top right-hand corner, and that wallet being the WebAuth wallet for the sake of this example. So once you've done that, then we can go into the video explanation. Alrighty, so another prerequisite that you're going to need in order to run this strategy is you're going to need to be able to fund your WebAuth wallet, and you're already going to need to be staking XPR, accruing those XPR staking rewards. So I'm just going to really fast show you how I personally fund my WebAuth wallet and how to enter into the stake position on XPR. Now, there's probably other ways to do this. This is just the most efficient way that I do it. I personally utilize Coinbase. So starting on Coinbase, I purchase USDC. So that's what we're going to go through in this video breakdown. There may be other, ways to fund your WebAuth wallet. Again, this is just the way that I personally utilize. So if you do it differently, so be it. But this is just to make it simplistic for you guys. Now, I've already went ahead and sent $50 in USDC to my WebAuth wallet, but just to run you through that. So I would come to Coinbase and I would buy $50 or however much of USDC that you want in order to fund your WebAuth wallet, $50, $100, whatever, it doesn't matter. So in this case, I've already done that. So buy USDC, just going to go to your Coinbase, buy the USDC. You can see that my Coinbase is already funded with about $50 for the sake of this example. Then we're going to come over here to the WebAuth wallet. And on the home tab, you're going to have the ability to select different tokens. Now you're going to you're going to select USDC. And we're going to click the receive tab up here in the top left-hand corner. And now I personally like to receive Stellar. So USDC on Stellar. So you're going to click Stellar and it's going to give you your Stellar deposit address and the memo. You're going to copy that deposit address and that memo. You're going to take it over to Coinbase and you're going to send your USDC on Coinbase over to your WebAuth wallet. Now, again, for the sake of this video breakdown, I've already commenced to that transaction. So you can see down at the bottom, I have $50 in USDC coin. Make sure that you confirm and double check the address and make sure that you're sending USD coin on Coinbase over to the WebAuth wallet on Stellar. You can choose different networks. I just personally like Stellar because it's pretty much feeless, right? Keep in mind also that sometimes these transactions, because of network congestion, can take some time. Sometimes for me, it takes 30 seconds. Sometimes it takes 5 minutes. So after you send the transaction, just put your mobile device down or, go keep yourself busy for 5 or 10 minutes and then come back and revisit. Don't freak out if it takes a long time. Even though you're sending it through Stellar, sometimes Coinbase can take some time to send your transaction out. It's not Stellar's fault, it's Coinbase's fault. So once you have the money in your WebAuth wallet, you can see there, now our goal is to swap this into XPR and then stake the XPR. So what you're going to need to do is you're going to need to connect to the MetalX app so that way you can use the swaps feature. So go ahead and open up the MetalX app on a mobile device, on the application itself, or on a web browser. I personally just like to have the web browser open, and I'm just going to go in and I'm going to connect my mobile by clicking that connect wallet button up at the top right hand corner. I'm going to authorize the connection, and then boom, now my WebAuth wallet is connected to the MetalX app. I'm going to click down at the bottom. You can see the swap feature. So we're going to go ahead and we're going to click swap. And then you can see my available balance is $50 and we want to swap that into XPR. So we're going to go ahead and click that balance, click the swap feature, approve the transaction for the swap in the WebAuth wallet, authorize. And now going back to my WebAuth wallet, clicking on XPR, you can see that my available balance and XPR has now increased to $49.61, whatever, right? Roughly about 50 bucks. Okay. So now let's add this to the stake. So we're just going to go ahead and we're going to click the stake tab up at the top right, and we're going to click the max button. And you can see that my staked amount slightly increased, and we're going to go ahead and click continue, and we're going to finish the stake. So if you don't have any XPR staked, you're initially going to need to do this step in order to participate in the looping strategy. You can only claim your staking rewards once every 24 hours. So because for the sake of this example, previously I already claimed my rewards, you can see that I'm unable to claim my rewards right now. In 24 hours, my staking rewards will pop up and I'll be able to claim them again. But now you can see that my $50 of XPR has now been staked. And so you will start accruing rewards immediately and will be able to claim them every 24 hours. So that is another prerequisite, is you will need to have the ability to fund your WebAuth wallet, depending on which route you take. This is the route that I take, and you will need to stake that XPR so that way you start, earning yield on your staked position. All right. So see you guys in the next video. So taking you guys through this video that I recorded, we're going to start here up in the top right corner of the MetalX app. We're going to click those 3 horizontal lines, and we're going to be utilizing the swap feature, because once we get our rewards from staking, we're going to need an equal amount of USDC and XPR in order to enter the pool. So we're going to connect our wallet by clicking connect wallet up in the top right hand corner. We're going to then click mobile, and it's going to allow us to directly connect our mobile WebAuth wallet to the MetalX app. All right, so we're just going to open that up. We're going to confirm, authorize, and connect to the swap feature of the MetalX application. And down here, again, our goal here is to enter in our staking rewards into the farming pool. So just to show you guys the farming pool that we're entering in, you can see the XPR USDC farming pool, 57% APR right now. My rewards right now are accruing. And then we're going to harvest these rewards and we're going to put them back into the staking pool on WebAuth wallet. All right. So now let's go over to the WebAuth wallet and let's claim our rewards. So you can see here, I have roughly about 771 XPR rewards, or roughly about $5.91. You can see up at the top where it says stats, my available balance says 0, and you can see how much I have staked, earning 4% APR, roughly about $26,000. So the goal here is to claim these rewards without restaking them. So it's going to ask you the question, do you want to restake the claim rewards? We're going to click no. Once we click no, it's going to claim the rewards for us, and it's going to update our available balance. And you can see now our available balance is at $5.92. But again, we want half and half in order to enter into the pool, half USDC, half XPR. So we're going to go back to that swap feature. Remember that we connected a second ago. And we're going to see, you see here how the balance says we have 771 XPR. We want half of that to be in USDC. So we're going to go over to a calculator, unless you can do this math yourself. But again, I just suggest you use a calculator so you get the numbers correct. So we're going to open up a calculator, and we're just going to put in that number and divide it by 2. So 385 XPR. We're going to take 385 XPR from our available balance, and we're going to turn that into USDC so that we have an equal amount of XPR and USDC to enter into the pool. We're going to click swap. We're going to open the WebAuth wallet, and we're going to approve the swap in the WebAuth wallet. Once the transaction is signed, we're now going to have an equal amount of XPR and USDC in order to enter into the pool. So then down here at the bottom, we're going to click the pool feature. And you can see right here, it gives us the ability to choose the assets that we want to plug into the pool. In this case, it's going to be XPR USDC. For other cases, what other farming pools you guys want to enter in on, you're going to need an equal amount of those assets. So if it's metal, XMD, if it's XPR SNPs, if it's XPR metal, you're going to need an equal amount of both of those assets. Since we're trying to jump into the XPR USDC pool, you're going to need an equal amount of both of these assets. Once we have an equal amount of both of these assets, you're going to click the balance of the USDC. So we're going to go ahead and click that. And you can see here how the enter amount button is not highlighted yet. So that's us entering the amount, clicking that balance. And then once you click that balance, the button's going to turn highlighted purple and it's going to change from enter amount to add liquidity, right? Once that add liquidity button pops up and highlights in purple, that is how you know you have the right amount of liquidity to add into this farming pool. So then we're going to go ahead, click add liquidity. That's going to again take us back into the WebAuth wallet to approve the transaction or approve the swap. Once we approve it, okay, now we have enough liquidity to enter into this farming pool. So then we're going to go back to the farming feature down at the bottom. You can see it. We're going to click farm. It's going to take us over to the farming pools. We're going to click XPR USDC. And now we need to update the stake. All right. So you see there the button that says update stake. We're going to go ahead and we're going to click that. All right. Once you click update stake, you're going to need to increase the staked LP tokens into the farm. So you can see here, it mentions that we have roughly about 80% in of the available balance. And so what we're going to do is we're going to drag this button up to 100%. You can see there, you can drag, you can take the button up to 100. We're going to put it at 100 and we're going to confirm. Again, it's going to take you back to the WebAuth wallet to confirm the transaction. Once you've confirmed, then your stake is updated, and that's how simple it is. So now what we want to do is we want to harvest these rewards, and we want to put these rewards into our stake position in our WebAuth wallet, right? So you can see right now my available balance, you can see, is only about 2 XPR. And so what we want to do again is we want to add our harvested rewards from our farming pool into our staked position on the WebAuth wallet, creating this looping flywheel. So we're going to go back to the MetalX app. And we're going to go ahead and we're going to click harvest. It's going to allow us to sign the request in the WebAuth wallet. We're going to go ahead and authorize. And then boom, then you can see that my rewards right there in real time were harvested. And boom, right there off the bat, you can see that my position is already accruing immediately. I mean, it's so phenomenal to watch the rewards just compound and compound and compound right there in real time. Going back to the WebAuth wallet, you can see that my balance, available balance right there on XPR increased from what it was to now 25 XPR. And so now we're going to put that 25 XPR back into the staked position. So I'm going to go ahead and click that staking tab right there. So you can see in the middle of the WebAuth wallet, right underneath of the balance, you can see the button that says stake with the little clock right there. You're going to click that. Once we've clicked that, then it's going to take you to this page and you see the little max button in the right-hand corner. You're going to click max and you're going to see your balance increase. Once you have the maxed amount selected, then you're going to go ahead and you're going to hit confirm. You're going to finish the transaction. And then staking is complete. So very simplistic flywheel. Now you can see the available balance has changed to 0. So that means the stake is complete. And you can see the staked amount down there at the bottom has increased. So all in all, very simplistic flywheel. At the end of the day, this is not a substantial amount of money. For example, I only just added 25 cents to my original 4% stake position, but over time, this will consistently compound. This will constantly accrue interest. And between now and 2030, I do not want to be sitting on the sidelines, not collecting, even if it's just 20 cents a day or $1 a day or $5 a day, and just compounding that over time. Compound interest is so powerful when you understand how massive this could get with price appreciation in the future. So hopefully you guys enjoyed this video breakdown. And remember, none of this is financial advice. Always make sure that you assess your own personal risk properly. This is something that I'm doing in my personal portfolio in the Metallicus ecosystem. And I plan to add additional farming pools in the future as my bags and my rewards grow. But for right now, I'm specifically focused on the XPR USDC pool. You all may be focused on other pools. I like the fact that it offers anywhere between 44 to 56% APR. So with that being said, again, hopefully you guys enjoyed, and I will see you all in the next video breakdown.
Thank you for joining us here on a lovely Wednesday. I'm glad the weather's cooperating. And for me, this panel is really exciting because I'm living this on a day-to-day basis. We actually just launched our first tokenized offering in Europe 3 weeks ago, where we're tokenizing 200 US listed equities and ETFs for our European client base. But I'm really excited because all of my panelists here are entrenched in the tokenization space, and I want to hear kind of what they have learned along the way and some insights they're going to share with us as we move from a pilot phase to a production phase. And so beside me, I have Amy Oldenburg. Amy is the head of emerging markets at emerging market equity at Morgan Stanley. Beside Amy, I have Ben Elvidge, who is the head of commercial applications at Trilitech. Sandy Cowell, who is the head of digital assets and industry advisory services at Franklin Templeton. I know Sandy, you have about 6 or 7 things after your title, so it feels like you're involved in everything at Franklin Templeton. And then Aviad Stein, who is the global head of strategy and innovation at Broadridge. And so maybe I'd love to dive into, I know you guys all have various stages of pilot and production tokenized offerings. How did you decide where to start first? And maybe Sandy, I'll go to you. How do you pick that first project and what goes into that decision?
Yeah. So first off, great to be here. We made our decision to enter this space back in 2018. And we made the decision to enter the space because we heard, oh, blockchain, great new ledger technology, can save you lots of money and effort in working in this distributed ledger. And we do a function inside Franklin Templeton called transfer agency, which is we keep the shareholder records on our own mutual funds. So if you buy and sell mutual funds, every day they need to update the record of who owns them and who sold them. And that's a huge, intensive ledger-based activity. And we do this across like 5,000 funds every single day. So we decided we wanted to test a fund on the blockchain to see if that would save us money. And we found out, wow, there is nothing to help us test this. So we had to develop our own wallet to be able to have a KYC AML compliant wallet. We had to develop our own tokenization engine and our own smart contract programming capability to be able to program the smart contracts to work with a regulatory framework. We had to create our own blockchain-based transfer agent process and transfer all of that onto the blockchain. And in operating on blockchain, we needed to then therefore become a node validator because that was part of our due diligence. How do you know how a chain is operating if you are not actually a part of that network? And so it started with a very simple aspiration to test the blockchain to see if it was an efficient bookkeeping ledger. And it kind of snowballed from there. And we began to realize, wow, we are onto something really transformational. So that was really how we got going.
And Aviad, I mean, one of the things, I know you guys have a lot of different use cases at Broadridge, but when you guys were thinking through your first use case, were you worried about cannibalizing existing revenue? Did that come into play at all when you made your decision? What did that look like?
So absolutely. First of all, thank you for the Ty and Josh and team for hosting us here. This is an amazing venue. To your question, absolutely. So, we started a journey about 6 or 7 years ago as well. And we recognized that Broadridge, for who we are and the ecosystem we're serving across asset management, and wealth management primarily, will be able to unpack some use cases specifically around the crypto market. And then we didn't really foresee the tokenization movement as it is kind of unfolding today. But we also build a DLT repo platform, which is by far the largest repo platform in the world that transact about $2 trillion on a monthly basis. And so that was one of the early kind of use cases that we started to kind of unpacking there. But there are some other dimensions to our kind of data strategy, our consumer strategy, and how do we serve the intermediaries in the space that we kind of put in a pilot mode. One of those areas was we recognize the complexities, going back to the last panel about the different type of wallets and the user experience around that. We developed different applications that will aggregate and create consistency around those type of wallets that consumer have access to. We actually call it Project Dumpling, just because the team was sitting and having dumplings for lunch, and we figured, why not call it Project Dumpling? Pretty much an aggregator, the wallet of wallets that will streamline and create a consistent view of all of your holdings across those type of wallets you have. And then lastly, what we try to do, which is very synergistic to who we are on the regulatory front and the communication business, which also address some of those cannibalization fears that we had internally. We realized that harmonizing and standardizing the underlying data in support of crypto assets and then the evolution around tokenized securities and funds and real world assets create a big opportunity for the marketplace from an adoption perspective, but also from risk mitigation. And so all of those things that we kind of start kind of tackling and unfolding and unpacking created risk to our existing business and how we serve our existing clients, but also created tremendous opportunity to really address some newcomers to the ecosystem, the exchanges that we never had relationship with, as an example. How do we shape up and advocate for certain regulations that can be favorable for those new asset types? And so we kind of try to balance, the fears that we had internally and how we future-proof not just our business, but evolving the ecosystem in a direction that it's honestly unstoppable at this point.
And Amy, I mean, you work at a heavily regulated firm, like many of us do on this panel. How did you guys think through picking the right project? Maybe starting with, clearly you have regulatory concerns in mind, but also, to Aviad's point, like making sure that it does get adoption internally and it's not seen as cannibalizing existing revenue streams.
Sure, and I can definitely resonate with my fellow panelists, and even what Sandy was saying about like having to build a lot of your own things. We went through this journey, everything from DLT to then we were on private chains, focused on like tokenizing the private asset classes. Now everything's talking about equities. Stable coins, again, a topic that's just huge this year. I think it's been one of the challenges is like there's kind of a moving target and everything's happening. But from the vendor perspective, like even when you're going through and you're trying to find the right vendors, you're trying to find the right partners, it's not something unique to digital assets. We see it everywhere, but almost every new vendor that we start working with doesn't pass our security architecture right off the bat. That's like a real big challenge. And this space is even more critical. So I think that's one of the biggest things that ends up having to talk about, like the whole buy versus build debate gets really complicated. To the point on, does this cannibalize your own business? Like we're already dealing with that with ETFs and active ETFs. It's a very real concept, even just in the transition of the business right now. I think the thing that's most challenging is like, this is an entirely new tech stack. So I always say like, we manage separate accounts on the investment side. We have mutual funds in different jurisdictions. Now we've had to spin up a new tech stack for active ETFs, which has been kind of a theme for a while now. And now we're saying like, oh, by the way, now we need CapEx to build out this entirely new infrastructure. So I think that's just been a tough part of this like kind of moving dot and trying to stay as organized as we can to like present that strategy to senior management.
And Ben, you guys are tokenizing something that probably wouldn't have come to mind right away for me. How did you guys come to that decision?
Yeah, I think we have the benefit of not being so heavily regulated at this point in time, and Trilitech's the adoption hub for the Tezos ecosystem. So we came at it from the perspective of what it has the most alignment if we're trying to use tokenization to broaden access to an asset, what has the most alignment with that potential audience, and actually what's going to create activity. And so we landed on uranium. So yeah, we launched the world's first tokenized uranium platform that's blockchain based in December. You know, we're going to go live with 3 exchanges tomorrow, which is super exciting. But you know, we took an asset that is critical not just from any perspective, but you know, for society generally in terms of nuclear energy and energy security, but also from an asset fundamental perspective is super interesting. It's uncorrelated to most major asset classes, and most importantly, going back to that original point, it's something that is a technology flavored commodity. Like, with the greatest respect, tokenized money market funds are interesting for most here from a collateral perspective and an institutional perspective. If what we're trying to do is broaden market access, taking something like uranium, where there is a lot of technology focus, and you know, most people have heard of uranium, whether that's positive or negative, they've heard of it. And so actually moving that to be something that's accessible and taking the barriers from $7 million to $4.5 is something that we found really interesting to do, and actually goes back to some of those core tenets of, you know, blockchain technology and the benefits it can bring to a market and moving a market forward. So that's how we approached it. We didn't have any concerns over cannibalization. So that was also, you know, easier to get through and get supported.
You have the benefit of not being heavily regulated, so you get to come at it from the innovation side a little bit more, maybe.
Yeah, for now. That might change after I've just made that statement here.
So maybe let's talk a little bit about the practical nature of tokenization. You know, clearly we're still reliant on traditional financial rails, whether that be banking, clearing, and settlement. Do you think we're stuck with relying on those rails and slow mint and burn cycles? You know, how do you think that we can innovate away from them, or kind of where are you guys seeing that line being drawn in your process?
Yeah, I'll start on this one. First off, I'm a little alarmed that the most unregulated thing up here is uranium. So,
And I wonder who your buyers are.
but all kidding aside, you know, look, I think that we are going to see a massive relocation of the industry infrastructure, right? And it's going to happen so much faster than people anticipate. You know, we like to say at Franklin Templeton, we're going to see more progress in the next 5 years than we've seen in the last 50. And that's simply because it is a superior. You know, look, I think that we are going to see a massive relocation of the industry infrastructure, right? And it's going to happen so much faster than people anticipate. You know, we like to say at Franklin Templeton, we're going to see more progress in the next 5 years than we've seen in the last 50. And that's simply because it is a superior set of rails, right? It offers you the ability to move away from this session-based 9 to 4, Monday through Friday activity to global 24/7, right? It allows you to move away from even an enhanced T+1 settlement cycle to atomic settlement, where assets and securities and assets and payments are exchanged instantaneously. It allows us to get rid of intermediaries that are toll takers and gatekeepers that add cost and fees. And it's going to allow us to reduce the amounts of collateral that we have to post to operate the system. Those are all compelling reasons, but the most compelling is going to be that the money is moving out of the traditional rails, right? The money that's coming out in stable coins is very rarely going back into the banks when it comes off chain. People are leaving money in these wallets. It's becoming a parallel economy, and we're going to see our entire set of financial services migrate onto this parallel set. In a sense, it's like what we saw with ETFs. To go back to the point you were making, is that like once it starts happening, it doesn't stop happening and it keeps spreading. And we've kind of passed that point of no return. So I think we are at the beginning of the migration. And I think that because these technologies are open source and easy to get to, it's going to happen a lot faster than anyone in the industry anticipates.
Yeah, I agree with you know, Sandy's vision. I think, and one
Process.
Yeah, I'll start on this one. First off, I'm a little alarmed that the most unregulated thing up here is uranium. So,
And I wonder who your buyers are.
but all kidding aside, you know, look, I think that we are going to see a massive relocation of the industry infrastructure, right? And it's going to happen so much faster than people anticipate. We like to say at Franklin Templeton, we're going to see more progress in the next 5 years than we've seen in the last 50. And that's simply because it is a superior set of rails, right? It offers you the ability to move away from this session-based 9 to 4, Monday through Friday activity to global 24/7. Right? It allows you to move away from even an enhanced T+1 settlement cycle to atomic settlement where assets and securities and assets and payments are exchanged instantaneously. It allows us to get rid of intermediaries that are toll takers and gatekeepers that add cost and fees. And it's going to allow us to reduce the amounts of collateral that we have to post to operate the system. Those are all compelling reasons, but the most compelling is going to be that the money is moving out of the traditional rails, right? The money that's coming out in stablecoins is very rarely going back into the banks when it comes off chain. People are leaving money in these wallets. It's becoming a parallel economy. And we're going to see our entire set of financial services migrate onto this parallel set. In a sense, it's like what we saw with ETFs, to go back to the point you were making, is that like once it starts happening, it doesn't stop happening and it keeps spreading. And we've kind of passed that point of no return. So I think we are at the beginning of the migration. And I think that because these technologies are open source and easy to get to, it's going to happen a lot faster than anyone in the industry anticipates.
Yeah, I agree with Sandy's vision. I think, and one thing Ben and I were talking about before the panel was one of the biggest obstacles is actually not the technology. It's human resources, it's policies, risk management policies. All of that has to be like significantly rehabbed and rebuilt. My team works 6 days a week. I have a team that's based in Riyadh, so our business days are Sunday through Thursday. And I'm used to working 24/7 now, so we're pretty close to 24/7. Our biggest challenge is trying to get somebody on Sunday to deal with our equity trading team that sits in Riyadh, because London's not in, and New York's not in, and Singapore's not in. Like, we need to seriously fix that problem, and it is getting very real very quickly. When we start having derivatives, one of the things I do on the EM side, and again, I sit on the Innovation Council and Digital Asset Committee, so I'm very active in the digital asset space too. But one of the first things I do on Sunday night before Asia opens is I start looking at the crypto markets to see what's moving, because usually I can start seeing some sort of indication for how the markets are going to open on Monday in Asia.
So definitely agree with all the points that my fellow panelists made here. But one point I think that we all need to kind of consider is that things are moving fast on the institutional side. When you start thinking about the retail side of the business, the number one, I think, obstacle is the literacy gap, right? People don't really understand what tokenization is as a concept, right? They don't really understand how you actually take an existing asset and what is the mechanism by which you can tokenize it, and what are some of the advances and the advantages, right, that you can have with tokenized, whether it's securities or funds, right, or any other instruments. And so I think we collectively as an industry, we're going to have to do a lot to both educate, make sure that we have adoption also on the retail side of things, whether it's going to be as progressive as, the 5-year mark, okay, that she kind of indicated here. The literacy gap, the data associated with that, the type of services, the type of solutions that it can unlock are still unclear for the average investor. And I think even for some institutions, right? I mean, some of them are playing, very deep into the space. Franklin Templeton, great example, right? That really took it seriously and taken the lead. But you see a lot of others are kind of trailing behind, don't really know where to start even the journey.
And so where would you start on the retail journey, maybe to put you on the spot a little bit? Like what's the right asset class or thing to tokenize for retail clients, in your opinion?
I don't think it's about tokenization. I think holistically, when we talk about kind of the education component of it or the lack of understanding, it goes with the data, right? What kind of data is in support of those type of assets? And it goes back to the crypto market. Right, if you're going to ask the average investor right now on the street if they know anything about the Bitcoin or the use cases or what the risk associated with the tokenomics, they would not know what to say, right? And because of that, you have a very lagging adoption in that space. And I think that's actually trailing back to the tokenization ecosystem as well. So I think fundamentally, we have to start educating, and through our existing rails that we are educating investors. It could be through wealth managers and asset managers, right, who need, to actually be in the forefront of explaining what are those different classes or different assets that are available right now, and what can you do with them.
I kind of have a little bit of a different point of view on this one, and I feel like it's kind of a cheat because you should really be answering this question. But I will do my best to answer for you. I would argue that retail has beaten institutional to this space already. That retail already understands the crypto markets far better than any institutional players understand them at this point. And that the capabilities and the functionality that the institutional financial services markets are going to need to develop are all coming now from the retail side. The gamification, the social interaction, the inclusion of short form video as forms of instruction, the ability to take actions on one's own that equate to what institutional players can do today. The ability to transfer assets peer-to-peer. These are all activities that retail are used to, and they operate with day to day in their everyday life. It's our institutional industry and it's our institutional rails that have kept us from keeping up with that level of innovation.
We're going to agree that there are massive opportunities on both fronts.
Yeah.
Okay.
So I'm just going to
disagree.
I'm going to take a slightly different view. So in the sense of, I think retail education is super important, but I don't think it stops at retail education. Certainly if we look at the market that we're operating in, actually there's a big education point that is less about education and more about narrative, I would argue. And so the things that are going to win out are the things where you can really demonstrate utility. And so to plug uranium again, of course, like it's uncorrelated. It's an asset that's scarcely been able to be accessed by retail. And actually what we're seeing about kind of bringing liquidity to the tokenized version is actually able to articulate the utility and benefit to those involved in the nuclear fuel cycle of you now no longer need to find £100,000 to be able to exit the market. You can tokenize that and you actually got better risk management and utility there. So I think it is about education, but more important than education, I would argue, it's about telling the right narrative and being able to articulate the right narrative around what the benefits are of a particular tokenized asset, whether that's a money market fund that can be used as collateral with near instant settlement, or whether that's, uranium, which is an asset you've not been able to access before.
Let's double click on the liquidity point there a little bit. Do you guys feel like we need to build liquidity in the tokenized version of the assets, or do you think we should rely on liquidity in the underliers?
I think we absolutely need liquidity in the tokenized versions of the assets, but I don't think you necessarily need to use the same solutions that we've used to build liquidity in traditional assets. So, I think that there's new approaches that we're experimenting with using smart contracts, using liquidity pools, using automated market makers. These are great opportunities to think about how to make the system work better. And I think that, the unlock to this really, I think, exciting set of capabilities is going to be, we need to upgrade the KYC AML laws, right? We need a better 21st century solution to digital identity and the ability to have a decentralized digital identity that players in a network can all rely upon. And that will unlock, I think, tremendous opportunities to build liquidity in this new ecosystem.
Anybody else want to take that? Otherwise, I'm going to put you all on the spot a little bit.
I'm actually surprised the digital identity piece hasn't gotten more traction. I mean, it's just so critical for so many parts of the business. And to your point on AML KYC, I mean, that's the big sticking piece, especially, being with an asset manager that is overseen by the Fed. AML KYC is as big of an issue to them as getting into crypto and digital assets. So, there's a lot of these solutions, and it kind of goes back to my earlier point, I think the other thing is that I was just going to mention is on narrative. The one thing that has to die is we're doing tokenization, not crypto. This is just something where you still run into people that are yeah, we're focused on tokenizing, but we definitely don't want to touch crypto. And I'm that's not even possible like anymore with where the world has gotten. So there's definitely some education where you have people that are still hanging out like 7 years ago in a narrative that may have existed.
I think that's really true. Just sort of first-hand experience, right? We've tokenized uranium. Uranium as an asset has about the same volatility, maybe a little bit more as the S&P 500. So much of our time is about having the conversation that just because this happens to exist and be recorded on a blockchain doesn't fundamentally change that asset and the nature of that asset. And I think inevitably, to the point around narratives again, the minute we say it's tokenized, people go, well, that's really volatile. Like, how are we going to deal with that? Because they automatically jump to meme coins and the like. And so actually that education piece from an institutional perspective has very much been about the legal structure we put around it and how do we use the blockchain to enable transfer of assets and title of assets without actually fundamentally changing the nature of that activity or the asset itself.
The last thing I would say, I think to Amy's point, right, even with the Clarity Act, right, I mean, if there's a call out, right, for KYC and AML, right, it's not really something that's a real focus over there, and I think it should be, right, because that's, I think, going to drive, again, that massive adoption that we're all kind of looking for.
So I'm a big proponent of not making mistakes twice. What advice would you give everybody who's thinking about taking something from pilot to production? That maybe a mistake that you guys have made or you've seen made that you would recommend people don't make as we look to move this forward quickly?
I'll start out. I think that you need to understand, I think one of the most unfortunate branding exercises ever was when we started calling them cryptocurrencies, because it created this expectation that somehow they're a currency and they can be spent on things. And you need to understand that it's a way of buying block space on the ledger. That's really the purpose. And so you need to hold these cryptocurrencies in your treasury if you're going to be recording trades on a ledger. And if you're holding these assets in your treasury, you need to figure out what you need to do to hedge against them. And that's when you need to figure out that you need to do node operations. So I think that there is this whole cascading set of realizations that you have, and you need to leave room in your organization for those realizations to take hold. Because people think they have a plan, and especially in big enterprise organizations, they like you to stick to the plan. And when you suddenly start telling them that there's all sorts of things that we need to add to the plan that they're not expecting, they feel like, oh, you don't know what you're doing, rather than, oh, there's a whole new set of learnings that we need to incorporate.
I would say it's getting an ally, especially for the larger firms, getting an ally in whatever you're tokenizing, like really locked in at the beginning. Because I think one of the things we've done with pilots is like we set up a pilot, we do the pilot, we get to the end of the pilot, everybody's like, yeah, this is successful, the innovation team like execute on it, and then it just doesn't go anywhere. So to your point on like pilot to production, like I think one of the things now with like even tokenized money market funds, working with our liquidity team, they've been doing a lot of work for a number of years, really understanding like how it comes together, and also like very visually, very open to seeing the disruption in their own business. So they're all in. And so you have that advocate within that transitionary place of the business that can help you take that pilot and really execute on it further.
I think for us, again, as a large company that serves, almost the entire financial ecosystem, it's all about the disruption component of it. So can we disrupt ourselves before someone else will disrupt us? Right. And I think for that, the whole pilot to production journey is really, really critical. It's about identify areas, that are second nature to how we serve the ecosystem, and then we can evolve and expand, or areas that we might want to play in that currently, whether we don't have the right skill set, or we don't have the right tool set, but we want to invest in. And I think that's part of the journey of kind of unfolding some of those opportunities. Some of it's going to inherently disrupt the way we operate today, I think, for each and one of us. But it's going to unlock opportunities, and you have to be open to that.
Yeah, I think lessons learned for us is figuring out what you need a production mindset from the beginning. So what has to be right even before you pilot, and where you can iterate. And for us, given the nature of the asset, it was very much about finding the right partners, ensuring that we have the right legal frameworks because we aren't regulated at this point in time. and ensuring that we're bulletproof on that stuff. And that took 2 years even before I joined the project to bring it to market. But where we can take more of a agile mindset in terms of iterating has really been on the distribution side. So actually, this is a new thing. You've not had access, retail investors haven't had access to physical uranium directly before. So let's try things. Let's build a DEX. Let's launch a DEX, which we did in December. Now let's look at centralized exchange listings. Let's look at where we can partner with institutions and take those learnings and adapt and move forwards. But I think what we've been able to do is separate between the things that we have to absolutely get right and the things where we can iterate and be a bit more agile about.
Okay, and maybe last question, just as maybe we'll start at Aviad and move all the way down to Amy. If you had 2030, what's the most tokenized asset class? If you had a crystal ball or you were placing a bet?
Uranium.
We hope so.
I love it. I think private equity.
I would say commodities generally would be my hope. I think it's more likely to be short-term fixed income.
Yeah, I'm going to go with fixed income also.
Well, I just want to thank all of my panelists for joining me here this afternoon. To Josh and the Ty, thank you for having us here, and enjoy the rest